At Momentum, we use fixed income within our multi-asset portfolios primarily to provide diversification, but also to provide income and capital growth opportunities where valuations look favourable. Ultimately, this aligns to our outcome-based philosophy and making the journey to that outcome as palatable to the client as possible. We use both passive and active solutions in our portfolios, preferring the low-cost passive option in what could be viewed as the more efficient, higher quality asset classes, and using active solutions to mitigate the risk of capital impairment and drawdown in riskier credit strategies. The natural asymmetry of fixed income as an asset class means the potential for upside gains is limited, whilst there is a very real downside risk. So active management fee budget is best spent on protecting against the downside risk in credit strategies. Consistent outperformance in rates and sovereign bond strategies is harder to find. It is fair to say that today, fixed income broadly remains expensive, especially when viewed in real terms over time. An aggregate style bond portfolio of global investment grade bonds, which includes sovereign, asset-backed and corporate issuers, currently yields 2%, which means if the policy goal of 2% of inflation is achieved, then you make a zero real return. That doesn't sound like great value. But when you look under the bonnet, across different geographies and asset classes, a differing picture emerges. Sovereign bond yields have diverged in recent months, with German bunds and gilts tightening, Japanese government bonds maintaining a near zero yield, and US treasuries widening. Notably so at the short end, which has seen the yield curve steepen markedly in recent months. So that means that today, with 10-year yields near 3%, we are seeing some value come back into the treasury market. But the flatter yield curve means that we can get a reasonable yield without having to take too much interest rate risk. Of course, there is a risk that the Fed tightens more rapidly than the market is discounting, but the higher entry yield today means you have a much bigger cushion before you lose money, nearly double what it was a year ago at the shorter end of the treasury curve. The yield curve is a closely watched cyclical indicator, which when it turns negative can portend a slowdown in growth as borrowing rates rise, usually in tandem with labour costs and inflation, and longer term investment becomes less attractive to finance. It seems that everyone is watching this statistic at the moment, which arguably reduces its effectiveness as a gauge of the economic cycle. What may yet prove interesting though, in this US yield curve cycle, is how the Fed manages the term premium, which is the additional yield earned from investing in longer dated bonds. With the Fed having been a significant buyer and current owner of treasuries and mortgage-backed securities, which are only now starting to run down, they have the means to manage the curve higher if the tail starts to wag the dog. Inflation is the number one risk for bond investors, and whilst we are seeing some signs of it picking up across geographies, it is far from becoming a problem. On balance, deflation probably remains the bigger risk today, certainly in Europe and Japan, whilst inflation is the bigger risk to investment returns. We have in the past favoured owning inflation-linked bonds, but today they look more fairly priced. In Europe, political risk is never far away. We witnessed a massive repricing in Italian bonds in May, with 2-year yields blowing out nearly 3 percentage points, as the market was spooked by the election outcome and the fiscal plans proposed by the resultant coalition. In Spain, Mariano Rajoy was ousted in a vote of no confidence, and in the UK, the Brexit process continues to draw out, weighing on sterling, although the increasingly softer Brexit tone will likely lend it some support. And in recent days, Theresa May has lost her Brexit secretary and her foreign secretary and finds herself under pressure once again. While talking about Europe, it is difficult not to mention the elephant in the room, which is the end of the ECB's asset purchase programme, which is expected to come to an end later this year. As this large marginal buyer of bonds disappears from the market, we are likely to see additional volatility in asset prices, not least European sovereign and corporate bonds. Corporate credit globally remains somewhat expensive in our view. We recognise that the cycle is more extended in the US, but it is likely to run further still. So while the fundamentals have probably seen their best days, we don't expect an imminent downturn. We just think credit lacks real value at these levels, and there are better opportunities in global equity markets today. Where we do own credit, we own more total return and shorter duration strategies, not because we don't want the interest rate risk, but more to mitigate the credit sensitivity of our portfolios. Fundamentally, European credit is more attractive as it lags the US credit cycle, but valuations are dearer still. Emerging markets is the bright spot for us, and although the sector is not without volatility, investors who can wear that risk should own emerging debt. Local bonds remain somewhat risky as the dollar enjoys a period of strength, but with all-in yields on hard currency debt over 6% today, after the recent weakness, we see value in the asset class and are buyers again today.